Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Surprise hikes, that's the prevailing theme on the ongoing markets. It started with the Australian Central Bank, which hiked rates by 25 basis against no hike expected. It was followed yesterday by Bank of Canada, which again hiked rates by 25 basis against no hike expected. We have the RBI's MPC decision, which will be out today by 10 a.m., and there is an expectation of no hike. The other strong narrative playing out in the is the depreciating Chinese yuan. After the central bank asked the big banks to cut deposit rates, yesterday's export numbers for the May shrank faster than market expectations. Good morning, JK. How are you reading into these surprise rate hikes, and what are your expectations from RBI's rate decision today?
Good morning, Swaraj. It's uh, back to be in India. Nice. And forget markets being volatile, the monetary policy itself is becoming volatile. So we had Australian and Canadian central bank who went on a pause after April, and then we suddenly find them hiking again, which is like saying that they're going back on their assessment of their economy and inflation. In fact, in earlier when Australian central bank was pausing, they said that they wanted to assess the impact of increases in rates to date, and that inflation has probably peaked, and there was substantial slowing in the housing economy, and now there is evidence that they may even hike once more after yesterday's second successive surprise rate hike by them. And then similarly, Bank of Canada made a statement in April saying that market participants realize that there is more pressure on central banks, and that they wanted to assess the rate increases which they had made thus far was having a substantial effect on the market, and that the economy might be cooling off. But now there was accumulating evidence that the economy was still hot and inflation was much higher. In fact, in Canada, we saw that employment data was quite hot. So they had decided yesterday to increase the policy rate after two pauses, and that reflected monetary policy was not sufficiently restrictive to bring supply and demand back into balance. So this is how the narrative from the central bank itself has been changing. Now, what do you expect for the market to do? Markets also remain volatile, and that's not really surprising. Now we have more central banks meetings coming up, nearest being Reserve Bank, and Reserve Bank probably is more predictable. I think probabilities of any surprise from Reserve Bank is much lesser, because we have data to suggest, unlike what we saw in the case of Australia or Canada, the data to suggest that inflation has cooled off. Headline inflation has come below 5% in May. In April. Then we had core inflation also dropping. Then growth has surprised to the upside, coming at 7.1% for 7.2% for the FY23, which was well above the forecast. And the Q4 of FY23 was also a surprise. So only thing of caution for the central bank would be the massive growth in the credit in the economy, where it indicates, in fact, the number is more than what was seen pre-pandemic, the growth in credit. So that is something that central bank will take note of, because already we have the liquidity position, improving, or in fact surging in the system, wherein the central bank has to come in and do more repos. So the focus of the central bank meeting by RBI today is more on not what the rate would be, but on what their revised outlook on growth would be, if at all, and on inflation also, because now that oil price has remained steady, but the global economies are getting into some sort of a slowdown. So how they see it impacting the Indian economy and the inflation is what I would be interested to look at. And of course, the liquidity management, because of the surge in liquidity in the system after the recent ban on the higher denomination notes, is something that we'll be looking at. Obviously, as has been the case in the past, the Reserve Bank decision on rates hardly have an impact on the exchange rate. And in any way, we know that the central bank has been managing the exchange rate on a stable manner So one shouldn't expect any movement out of the central bank decision in terms of the exchange rate. Then we have the Fed meeting next week, not too far away. Now, will Fed take cues from Canada and Australia not to go back on their pause and then right away straight increase the rate? That is the question. But in my view, no, because now Fed has to contend with one more issue of tighter liquidity that is going to haunt the US financial system. As per reports, they have to raise as much as 1 trillion USD of liquidity for funding their treasury general account, and as also to make up for the borrowing calendar of the government. And this will be in addition to the QT of 95 billion that they have been continuing for quite some time. So this is equivalent of, in some calculation, equivalent of about 0.25% increase in the rate. So I think Fed's intention is not to declare that 1 over inflation. It is to indicate to the market that they don't want to pressure the market or the economy too much by a surge of liquidity tightness as well as the rate increase. So in all probability, Fed's rate not changing next week is only a skip and not a pause. This is very clear. So I think because the economy, unless next week's inflation data really surprises to the downside, which is something that we cannot speculate right now, because having seen personally what the lives of the people there have been affected in two ways. One is the high inflation, particularly on the services side, and secondly, also the interest rates. Suppose the mortgage rates have actually doubled from pre 2022 rate hikes, and people are left with very limited cash reserve, and this obviously puts pressure on wage increases, and wage increases is something that Fed would not like. Therefore, I think Fed is in no position to say that peak rate is in, and it is like postponing the meeting for 1 month. That is how one should interpret the skip by Fed in June as. So, but coming back to markets, we did have somewhat mixed reactions in the markets on particularly on the stocks. We had the Nasdaq falling more than 1% yesterday, and that is not surprising given the one-way rise we had seen in the AI-related sectors, and we also had the tightness in monetary policies re-emerging, which made investors cautious. On the US dollar itself, it is currently in a very tight range, but looking at the way US economy's numbers are coming out, not really as weak as people were assessing, and the inflation of course needs to be watched out. Yellen says that the inflation can fall further, but unless the Fed sees evidence of that, I don't think they're going back. So I think dollar remains well supported. On the European side, data continues to be weak. So while inflation is high and they are not going back on need for another 2 more rate hikes in Europe, which means that we are very much on the way to stagflation as far as Europe is concerned. So in this scenario, we cannot but see the dollar on a very firm footing. Like you had a good number on GDP from Japan also today, but that is one central bank which is staying quite different from all others, and they are not reacting to any improvement in the economic data nor in the inflation going up. So it's an odd man out. So that's also a part of the monetary system, global monetary system. So that's why I said the monetary system or the monetary policies are all over the place now, and investors are really not in a position to take any directional call, be it on the bonds or in the stock market. They are, I think, moving in a very narrow, uncertain range. That is how I would say, even the dollar. But my bias for the dollar would be slightly higher because of the expected liquidity tightness in dollar that we will be seeing in the coming days. As far as the USD is concerned, we are slowly again slipping into a 10 paisa range, or maybe even less than that. And usually we have seen that this type of tightening of the range eventually leads to a blast either side. And currently, my bias, looking at the dollar index and the Chinese yuan, the way it has been weakening steadily, even now touching 7.15. I would be inclined to think that USD INR is well supported. Breaking 80 to 85 will be some effort, but if it does, 83 should be tested, and the reserve of the central bank would also be tested after that. So it's interesting times ahead, although we're not seeing big movements right now. Thank you.
Thank you, JK. And I really like what you said in the start. Forget markets being volatile, monetary policy itself has become volatile. Inflation has been running hot, as told by central bankers from Australia and Canada. Of course, from India, there is evidence that inflation has cooled both headline and core, while growth has remained strong. What markets will be looking at today is the revised growth forecast by RBI. We have the Fed meeting next week. What's to be seen is, will the Fed take inspiration from Canada and Australia, while Japan remains odd man out in the monetary policy system, as they haven't been changing their policy stance amid the strong data. That's it from us today. Thank you so much for listening. We'll see you all tomorrow with another round of fresh updates.